a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are looking at ETFs with eye-popping yields of 200% or even more, in this case 231%. But should you buy these ETFs just because of these insane yields? And in fact, I got a question from one of our viewers whether these are too good to be true. So I decided, let's take a look at these ETFs. So a little bit of background about options-based income ETFs. These ETFs that use option strategies to generate high yields have become immensely popular in recent years. And the JP Morgan Premium Income Fund, JEPI, that is now the largest actively managed ETF with over 36.2 billion in AUM. It continues to gather assets despite its underperformance relative to the S&P 500 index. So in general, these strategies tend to underperform in bull markets. They generate monthly income by selling call options. But if the market declines or the underlying stock declines, then they decline somewhat less. So some protection when stocks fall. So JP Morgan ETF, the JEPI ETF, that holds a portfolio of defensive stocks, and then they sell out of the money S&P call options to generate those monthly income distributions. Now, some of these newer ETFs, like the one that I was talking about earlier, they trade options on single stocks, and then these can generate those eye-popping income yields. So we are talking in particular about YieldMax ETFs. They currently offer 31 ETFs with about 4.3 billion in AUM. Now, as I mentioned, unlike JEPI, these trade options on single stocks, and they provide synthetic exposure to the stock, unlike JEPI, which actually holds those stocks. And they have some very interesting ETFs. Their most popular ETF, as you would have guessed, is the one which uses NVIDIA underlying exposure. So NVIDIA, that has about 1.3 billion in assets, and other popular ETFs are Tesla, Misty, Kony. Let's take a look at the ETFs, YieldMarks ETFs. So I had showed SMCY earlier, which had the yield of 232%. Now, SMCI is an interesting and an unusual case. We'll talk about that, but they have some more ETFs which have close to 200% yields. So they also have some fund-of-fund income strategies as well, in addition to these single stock income strategies like the Magnificent Seven fund of option income ETFs, etc. But the most popular ones are those on single stocks. So let's dive a little deeper. So what we will do today, we'll take a look at the distribution yield. How is it calculated, and can that yield change? Then we will take a look at the underlying strategy, and then we will look at the performance and other risks. So let's talk about the distribution yield. Let's go to the code page again. So let's take a look at the yield of SMCY, because that is the one which is eye-popping, 32%. And they describe how this yield is calculated. So basically, the distribution yield is calculated by taking the latest monthly payout and then multiplying that by 12, and then dividing by funds AUM. So they had one distribution, and then that was multiplied by 12 So they had this distribution. This was multiplied by 12 and divided by the fund's NAV. And we know what happened with SMCI stock. Last week, the stock had plunged more than 32% after its auditor, Ernst& Young, resigned. That is after raising concerns over the company's internal controls. Earlier in August, short seller Hindenburg Research had targeted the company. So, in general, this stock has been very volatile, and those distribution yields can vary significantly month to month because the income from selling options that fluctuates with underlying stock movement, changing changes in implied volatility, and other factors, including interest rates. So, this distribution yield can change, and in case of SMCI, it's most likely going to change. So, what you are getting this month may not be what you get next month or going forward. This is something investors should remember. Take a look at the distribution and take a look at how this distribution yield is being calculated. Now, what do these ETFs hold? So, if you look at the holdings, you will see that they have long and short positions in call and put options, and then they hold treasury bonds for collateral. So again, let's take a look at one of their most popular ETF, NVD. So you can look at the holdings, and this is what you will see. So you will see those treasury bond which are being used as collateral, and then you will see those call and put options. And in fact, we can look at the prospectus, and this describes what these holdings aim to do. So, principal investment strategy is they provide synthetic exposure to the underlying security. And why do they provide synthetic exposure? Because synthetic exposure to the stock can be created with less capital. So basically using leverage. So this is one of the principal strategies of selling options. And then they generate monthly income. So for generating monthly income, they have described their strategies. So their standard strategy is to sell covered call. And then in addition, they also employ this opportunistic strategy of using credit call spreads. So that is why you will see those call options with different strike prices. That is for creating credit call spreads and generating higher monthly distributions. And they also have examples here. So if you want, you can go through those examples and understand how they generate those insane income yields. Now, then let's talk about the performance versus the underlying stocks. So because of those insane amounts of yields, the prices of these ETFs, they continue to go down. And in fact, I looked at the total return of some of the popular ETFs versus the performance of the underlying stock. So total return includes the appreciation as well as the income. So NVD, which is their most popular ETF and also the best performing one because NVIDIA stock has done so well. This is about 200% since its inception in May of 2023. But NVIDIA stock has gone up 374% during the period. So you actually missed out 174% in price appreciation because of holding the ETF instead of holding the stock, NVIDIA stock. Now let's take a look at Tesla. Tesla versus Tesla. So this is an ETF which hasn't done much. So Tesla is almost flat since its inception in November of 2022, whereas Tesla stock has gone up slightly. So Tesla's stock is up about 36% during this period, and Tesla's return is almost zero. The third fund, which I have highlighted for performance, is the newest one, their ETF with the highest distribution yield and also the worst performing. So SMCY and SMCI, we know plunged. So this is their new ETF since its inception on September 12. SMCY has fallen about 34%, whereas the stock SMCI fell more than 41%. So, yes, the fund fell a little less, and that is because of that income cushion, that investors got. Additionally, you should remember that there are other risks too in addition to underperformance of your fund versus the underlying stock. Expense ratios are high, usually around 1% for these ETFs. And we should also remember that tax treatment for option based income is slightly adverse compared to dividend income. But for some reason, if you love those juicy monthly distributions and you don't care for the price declines, so these ETFs have made it easier and more convenient for you.
Thanks for watching. Make sure to check out zax.com/promo for an interesting offer. Make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.